Good morning, viewer. Welcome to our first activities. Yes, inflation. How long will inflation last? The answer lies in the past. The Federal Reserve's favorite inflation-related adjective used to be transitory, as in inflation is transitory and price increases should be temporary. That is no longer the case. Inflation rates have been increasing sharply since August 2021 and have been out of the normal 2% to 4% range for a full year. The consumer price index rose 8.5% for the year ending in March, a rate that had not been seen since December of 1981. So the central bank has broken up with transitory and set its eyes on a new inflation modifying term, entrenched. It is our job to make sure that inflation of that unpleasant high nature does not get entrenched in the economy, said Fed Chair Jeremy Powell last Wednesday, just after he announced a half-point interest rate hike to combat inflation. It is unclear what exactly entrenched inflation looks like or how we will know if we have reached it. The Fed has given very little guidance in general on how long they predict it will take for their interest hikes to lower inflation. It is a very difficult environment to try to give forward guidance 60, 90 days in advance, said Powell last week. There are just so many things that can happen in the economy and around the world. There is nothing investors hate more than uncertainty, and as increasing rates pummel US market, they want more guidance. Americans who have been hard hit by rising gas and food prices also want to know when they can finally feel some relief, especially if the Fed's rates hikes risks dragging the economy into a recession. Looking to the past could offer some insight. Although prices have been relatively stable over the past 4 decades, large swings were not uncommon before the early 1980s. History and Fed data show that the driver of inflation is important in predicting when rates will finally decrease. Prices grew at very rapid rates during World War I and World War II as a result of wartime's constraints, but fell again when peace times resumed. In the 1970s, the US experienced its longest stretch of hidden inflation. President Richard Nixon removed the dollar from the gold standard, and two surges in oil prices pushed inflation rates to 12.3% by date 1974. The Fed began practicing stop-go monetary policy, rising benchmark rates as high as 16% and then quickly dropped them again, leading to a cycle in which increased interest rates were not sustained for long enough to end inflation or increase growth. By the late 1970s, Federal Reserve Chair Paul Volcker took over and ended that policy. He raised rates and kept them high until inflation came down, throwing the US into recession, that is its second of the decade, but finally permanently lowering inflation rates where they remain for next 40 years. I have tremendous admiration for Volcker, said Powell last week. When asked about his policy changes, he had the courage to do what he thought was the right thing. So will it take nearly 20 years and two recessions to get us back to normal? Powell certainly does not think so. The economy is strong and the unemployment data looks nothing like it did in the 1970s. Powell said many people believe that we have already reached an inflationary peak and numbers are beginning to flatten. Analysts often speak of the fears of 1970s stagflation and compare our current situation. But today's inflation is caused by a mixture of global crisis, supply chain disruption, and growth in consumer demand after COVID lockdowns shut down the economy. The inflationary period after World War II is likely a better comparison for the current economic situation than the 1970s and suggests that inflation could quickly decline once supply chains are fully online and pent up demand levels off, wrote the White House Council of Economic Advisor in a recent white paper. Still, as growth slows and markets drop, the two forces stagflation and sticky inflation get thrown around with increasing frequency. Some investors think the answer in the middle. We expect US inflation to show over the next 2 years, but the progress will be very uneven, wrote Bank of America analyst in a recent note. There is tentative evidence of an easing of supply chain challenges, and we expect 2 steps forward, 1 step back process in the next year. But this won't be a decade-long struggle. They predict prices should begin to ease by 2023. It has been a bad few weeks for tech stocks, but analysts are still keen on at least one name, Google parent company Alphabet, that is called GOOGL. Tech titans have fallen victim to rising rates of lackluster earnings this spring. PayPal, Amazon, Facebook, parent company Meta Platforms, and Netflix all took nasty spills in April, and the Nasdaq had its worst month in nearly 14 years. The forward-thinking tech sector is particularly vulnerable to higher rates. Investors expect tech companies to post electric growth, but inflation and higher interest payments will take a big bite out of this profit. But not all companies will be hurt equally by the great tech wreck of 2022, say analysts. Many see Google as a green oasis in a desert of rain. Google has withstood a few recessions already and held up pretty well, said Raymond James analyst Aaron Kessler. Typically, the last thing advertisers cut is your Google spend. The numbers add up. Google search growth remained solid at 24% in the first quarter, and Google Cloud revenues increased 44% during the same period. YouTube advertising revenue fell below expectation as advertisers in Europe pulled back at the start of Russia's invasion of Ukraine. But YouTube's scale remains unmatched with over 2 billion monthly active users. More than a third of YouTube users are not reached by any other ad-supported streaming services. Beyond the report for Shakti USA.